Welcome back, finance enthusiasts. The SIE, Securities Industry Essential exam, is an excellent way to begin your career in the financial investment sector. It encompasses the fundamentals of the industry and prepares you for more advanced examinations. Now let us continue preparing you to pass the Securities Industry Essentials SIE exam with a discussion of municipal fund securities, the follow-up from our previous annuities video, and end this segment with 529 plans. Municipal fund securities. Although municipal fund securities are categorized as municipal securities, they may not possess many of the features typically associated with traditional municipal securities. Instead, municipal fund securities seem to have characteristics more akin to investment company securities or variable contract products. For instance, municipal fund securities provide investment returns and are valued based on the performance of an underlying pool of assets whose aggregate value may fluctuate daily, rather than providing interest payments, either paid currently or at maturity at a stated rate or discount, as is the case with traditional municipal securities. Additionally, unlike traditional municipal securities, municipal fund securities do not have stated par values or maturity dates and cannot be priced based on yield or dollar price. Let's examine three different forms of municipal fund securities: local government investment pools, LGIPs, 529 college savings plans, and 529 A plans. Local government investment pools, LGIPs, are trusts established by state and local governments, offering municipalities a venue to invest their money. Government entities use their surplus cash to purchase interests in a trust that invests the assets in a large portfolio of securities, according to the trust's investment objectives and state laws. Since only municipal governments and their instrumentalities may invest in LGIPs, they are not open to public investment. The purpose of LGIPs is to encourage the efficient management of government entities' cash reserves, which otherwise have limited investment options. LGIPs provide an investment alternative that minimizes the risk of principal loss while offering daily liquidity and a competitive rate of return. By pooling their funds, government participants benefit from economies of scale, diversification, professional portfolio management, and liquidity. Section 529 College Savings Plans. Section 529 of the IRS Code, amended by Congress in 1996, enabled the establishment of state-sponsored, tax-deferred college savings vehicles. The two types of 529 plans that can be used to meet higher education expenses are prepaid college tuition plans and college savings plans. Prepaid tuition plans, or PTP, are designed to cover tuition costs at public in-state colleges and universities. The donor may pay tuition in one lump sum or through installment payments. Some prepaid tuition plans offer contracts for a 2-year or 4-year program and can cover 1 to 5 years of tuition. Other plans may even permit the contract to be applied to graduate school, residency requirements, and other limitations. Many PTP plans require that the donor or beneficiary be a resident of the state offering the plan. Some plans also limit enrollment to a specific period each year and may restrict the expenses that are covered. For example, some plans may cover tuition, books, and laboratory fees but may not cover room and board. Prepaid tuition plans do not give the donor any investment options. Transferability. If the beneficiary of a prepaid tuition plan chooses not to attend a college covered by the plan, most plans allow for a transfer to another sibling of the original beneficiary. In some cases, age restrictions may apply. Additionally, if the sibling decides not to attend college or if the donor cancels the plan, only the original contribution will be returned, and any interest earned on the plan will be lost. In fact, some plans may charge a cancellation fee. Prepaid tuition plans are not considered municipal fund securities. Essentially, these plans lock in tuition costs at today's levels and protect the saver against future cost increases. Unlike college savings plans, tuition plans are not self-directed and typically offer guaranteed returns. College savings plans. College savings plans, commonly known as 529 plans, resemble a 401k plan in that they provide mutual fund-type investments that grow on a tax-deferred basis. Some plans offer limited investment choices, including age-based portfolios that automatically adjust the asset allocation based on the beneficiary's age. These plans usually shift money from stock funds to bond funds as the child approaches college age. Under federal law, contributions are made with after-tax dollars, but any earnings grow on a tax-deferred basis. Earnings in a 529 plan account are not subject to federal income tax, and in many cases are also not subject to state income tax when used for qualified higher education expenses. Qualified education expenses include those incurred for tuition and fees, room and board, as well as books, supplies, and equipment. States that offer 529 plans are responsible for determining specific plan rules such as allowable contributions, investment options, and more. Expanded use of 529 plans. While originally intended solely for college educational expenses, the funds in 529 plans may now also be used for expenses related to elementary and secondary schools at public, private, or religious institutions. Currently, individuals can withdraw up to $10,000 annually from their 529 plans to cover private school tuition and books for grades K through 12, in addition to using their account proceeds for college costs. Additionally, individuals are now permitted to withdraw up to $10,000 on a tax-free basis, a qualified withdrawal, to repay qualified student loans and for certain apprenticeship program expenses. This limit applies to the beneficiary and each of the beneficiary's siblings. Contribution limits. Current tax law allows a tax-free gift of up to $15,000 to any one person in a given tax year. A 529 plan may be front-loaded with an initial gift of up to $75,000, which is treated as if it were made over a 5-year period. 5 contributions of $15,000 each. Individuals can also contribute these amounts to 529 plans maintained for multiple beneficiaries. For example, if an individual has 5 grandchildren, she can contribute $75,000 to each grandchild's 529 plan without incurring federal gift taxes. These amounts double for a married couple funding multiple 529 plans. States determine the total amount that can be contributed to a 529 plan, and most use a figure sufficient to cover an undergraduate degree. 529 plan advantages. These plans allow the owner to change the beneficiary once per year. However, the new beneficiary must be a family member of the previous beneficiary to retain federal tax benefits. The ability to change beneficiaries means that funds contributed to a 529 plan can leave donors' estates while still under their control. Many plans have no time limit for when the funds must be withdrawn, and the donor can authorize payment for future educational expenses. Additionally, account owners can adjust their holdings in a 529 plan twice every 12 months, previously allowed only once a year. Direct or advisor sold. 529 plans may be sold to customers in 2 ways. Direct sold, where there is no salesperson and the plan is sold directly through the 529 Savings Plan's website or by mail. And advisor sold, where the plan is sold through a broker-dealer that has a signed selling agreement with the primary distributor of the 529 plan. Some states may offer plans only directly, typically to their residents, while others have agreements with broker-dealers to offer the plans directly. While fees in direct sold plans may be lower, customers do not receive the advice of an investment professional. Section 529A plans. Similar to 529 college savings plans, 529 ABLE, or simply referred to as 529A, accounts are savings accounts administered by the states. The 529A plan was authorized under the Achieving a Better Life Experience, ABLE, Act to supplement support for persons who are disabled or who meet the government's definition of disabled and are receiving Social Security disability, Medicaid, or private insurance payments. In the past, if a disabled person earned more than $700 per month or had assets exceeding $2,000, they risked losing eligibility for government programs. Today, a 529A account will not affect Medicare or Social Security payments unless the current account value exceeds $100,000. Once the account value falls below the $100,000 threshold, federal and state aid resumes. A 529A account may be opened in any state that has a nationwide ABLE program. The maximum contribution to the account is $1,000 per year and is made on an after-tax basis at the federal level. It may be pre-tax at the state level. Unlike a 529 plan, there's no 5-year front-loading of contributions, and there may only be one 529A account per beneficiary. The earnings are tax-free if used for qualified expenses, including basic living expenses, education, employment support, housing, financial management, legal fees, transportation, and wellness. If the funds are used for non-qualified expenses, the earnings are subject to taxes at ordinary tax rates and a 10% tax penalty. Upon the termination of disability status or death of the beneficiary, the assets in the 529A plan are used to pay off the state Medicaid agency for any expenses incurred after the ABLE plan was established. The assets of the plan may also be rolled over to an eligible sibling without triggering a taxable event. Offering documents associated with 529A plans, as well as continuing disclosure documents, are available on the MSRB's Electronic Municipal Market Access (EMMA) system. EMMA is an online repository maintained by the MSRB. This concludes the examination of variable contracts/annuities and municipal fund securities. These products have unique features and can be very attractive to various investors. The next segment will examine securities products, including direct participation programs, DPPs, real estate investment trusts, REITs, hedge funds, and exchange-traded products, ETPs. As we conclude this segment, we invite you to show your support by liking this video and subscribing to our channel. It is a simple click for you, but significant support for us, and it is entirely free. Please turn on your notifications to be among the first to be introduced to the examination of securities products, including direct participation programs, DPPs, real estate investment trusts, REITs, hedge funds, and exchange-traded products, ETPs, to excel in the SIE exam.